Boy, I am not really looking to buy many stocks right now. What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about quite a few different things. Still, the most common question I get asked daily is, why aren't you buying more of X? Whether it's why aren't you buying the S&P 500, or why aren't you buying a growth stock you spoke about 8-9 months ago, or even a value stock, whatever it is. People are asking me, why aren't I really buying these things? Because I said in my last video, I've only really bought a few stocks over the last few months. The ones I really believe in, the higher growth ones, I think it was Palantir, Corsair, and Tesla. I'm not here today in order to try and spread fear. In fact, I want to try and do the exact opposite, because I think having a plan and having a better understanding of what potentially could happen going forwards based off of past events can make you feel more confident in the decision you make today and the decisions you're going to make over the coming months. So in order to do that, there's a few things I want to speak about. I want to speak about the Consumer Price Index, CPI. I want to speak about inflation. And I don't just want to say that, the Fed said it can go up, etc. I want to really speak about it and show how it's affected the stock market, particularly the S&P 500, and how valuations are very, very high, and that can't be ignored. If there's anything that the last few months have taught us about the stock market, is that valuations can't be ignored. Yeah, they can be for a little while, maybe for a few months, maybe for a year, but not forever. There's a reason the S&P has historically been at, a 14 to 16 PE ratio. We're going to speak a little bit about hedge funds, okay? The fact that we saw record selling by hedge fund clients not too long ago. I want to speak about the fact that they are selling single stocks more so than buying them, because hedge funds don't lose. There are clues being left everywhere, left, right, and center for us, my friends. And this is actually where I'm putting more of my time lately. I'm not spending as much time researching these new companies. I'm trying to figure out the bigger picture, because ultimately I think that's going to stand with us a lot longer. I also want to speak about two more things. Biden and the Fed wanted a hot economy, and also this, China's new cross-cyclical economic policy strategy, and how the two are quite different, and how that could again cause some issues over the months to come, in my personal opinion. I ain't no economic expert. Now, please do remember, my friends, that everything we speak about in today's video is just my thoughts and opinion. There's no way of predicting what's going to happen in the future. If there was, somebody would be a very well-respected person. Anything could happen. I'm not going to be given specific timelines because, again, I don't think I nor anybody else can do that particularly accurately, even the experts, or else we would have a much better idea of what's actually happening. So just remember that. Take everything with a pinch of salt and always go out there, do your own research, form your own thoughts and opinions in regards to, the bigger picture and also your individual stock picks. Please, my friend, could I ask you to hit that juicy like button, because I know it's a different kind of video, but honestly, I think this one will bring a lot more value to people than the average one where we just speak about a stock or some news on a stock that we've been following for a year. Drop me a comment down below, especially if you'd like to see more videos like this where I actually keep you up to date with, the broader economics of things as opposed to just little bits and pieces of news. And please, my friend, if you are indeed new around here, consider hitting that juicy red subscribe button. I'm wearing a shirt today. I don't think I've ever wore a shirt. It's not a real shirt. It has short sleeves and stuff, but yeah. So before we even speak about all this, let's just think about things logically. I think anybody who's in the stock market and follows it, even just a little bit, will be aware that, the Fed is letting interest rates go up. This paragraph here sums up what's happening, okay? The notion of creating a high-pressure economy is that government should be willing to risk a bit of inflation in the near term, instead of 2%, closer to 4% potentially for a while, to achieve conditions that will, over the long run, lift people out of poverty, prevent the scars of recessions from becoming permanent, and make the nation's economic potential stronger. So obviously, it sounds fantastic. What does that really mean? Okay, it means there's going to be a surge in money that's in the economy. There's going to be a surge of people working, hopefully, less poverty, etc., etc., which is awesome. In an ideal world, if this worked out perfectly, it would be absolutely amazing. I mean, why wouldn't everybody just do this forever? Why would you decide to keep inflation at about 2% per year? Why not just put it up to 5%, 10% a year? Let everyone make loads of extra money. There's a reason, and I think everybody knows it. Look at the S&P 500 PE ratio. I mean, this here, guys, is genuinely a little bit scary. It's currently very close to 35. It's only been there at a couple of other occasions throughout history, both of which have been over pretty much the last 10 years. That's not normal. There's a reason why, every time it hit 20 in the past or 25 in the past at a push, it would take a sharp decline down. And anytime it fell below 10, it went up very quickly. There's a reason. But what I'm trying to point out in today's video is that it doesn't always look like this. It's not always up and then straight down. Look here, all the way from 1980. We hit the bottom. It went up. Beautiful. One of the best stretches ever. It took a pullback. It continued to go up for 20 years until it reached the highs, where then it went down for 7-8 years to reach the lows. So the reason I'm not particularly excited to buy a lot right now is because there's no clear direction whatsoever. What there is clear valuations. There is clear government intents going forwards. There is clear ideas out there that things are probably going to appear better, but actually be worse from a long-term point of view. All we have to do is go back to the S&P 500, okay? When it was at the bottom, when it was here around March, most people weren't very excited. They didn't see the upside. There was still so much bad going on in the world. But when it ran from 2019 to 2020, up 30+%, you bet people were excited. There was so much optimism. Then the Roni hit, okay? This was the best time to buy right down here at the bottoms. And I know a lot of people did buy a lot at the bottoms, myself included. It was awesome. But now, look at that. 92% up in less than a year and a half on the S&P 500, my friends. I mean, does that make sense to you? It does not make sense to me, and it's not just the S&P 500. But anyway, if we go all the way back to July 2020, we can see the 1 month percent change in the CPIU was at 0.5%. It steadily went down until October, where it was only 0.1% before beginning to make upwards moves, okay? Now, April, all the way up to 0.8. May, there was a decline to 0.6. June, back up to 0.9. July now, back down to 0.5. Again, there's no clear direction whatsoever. And I don't think you have to be a genius to figure that out. I don't think you even have to look at the consumer price index to figure that out. There's still a lot of uncertainty in the world as of right now. There's still a lot of people who maybe 1 week they will get to go out and they will get to spend some money. And the next week, they have to stay indoors again for 2 weeks. So the consumer price index for all urban consumers, the CPIU, as we said, increased 0.5% in July. The large majority of this over the last 12 months in particular is coming from energy, commodities, gasoline, fuel oil, energy service, things people need to spend their money on. You will see a lot of the rest has stayed stagnant. Look, apparel hasn't moved up in July. Medical care commodities, okay, look, negative 2.1% on just a 12 months. Even things like food up 3.4%. Food at home 2.6%. Yeah, food away from home has gone up a bit. So from what we can tell, I think most people would expect consumer spending set for a strong growth during 2021, 2022 because it makes sense, because inflation is set to go up at considerable rates. But when I'm reading through these articles and I'm reading through the CPI, a lot of people aren't taking into account we don't know what's going to happen over the next 3 to 6 months. Just like back here, people didn't know the Roni was going to hit. Guys, the Roni is not gone. And there's new strains, you know? Simply put, there's still a lot of uncertainty. I think a lot of people are just deciding to look past it. And again, if the last 2 years taught us anything, is that you really can't look past these valuations for too long. Even if you don't follow the indexes or whatever, if you're watching this channel, you probably follow at least some sort of growth. You probably, we're here for the SPAC craze. You've probably seen the crypto craze. None of it lasts forever. It really is that simple. The winners do always some good picks in there, but not everything can stay up forever. Now, this is a chart that's been used a lot around YouTube and stuff, but look, there's been record selling by hedge fund clients. This is from Bank of America Securities, by the way. Look at that. Absolute record lows. Lower than the recession. This is the hedge fund clients. This is the hedge funds, my friends. It's not me and you. It's the big boys. And hedge funds don't lose. Hedge funds were net sellers of stocks in North America last month, but flows were mixed according to product type. Funds sold single name stocks throughout the month, but were net buyers of ETFs. Morgan Stanley found the net selling was driven by an 80-20 split between short selling and sales of long positions. Look guys, hedge funds make money everywhere. They are one of the very large reasons that the stock market moves. They can move it up and they can move it down essentially at the snap of a fingers. Now there's a lot more to it obviously than that, but everybody knows they do manipulate the market, simply put. Why are they buying if valuations are so high? Maybe they want to make them even higher. They're more than likely going to be shorting them all this way as well. And you can go and double check all these things, but they've probably been shorting it here and here and here and here. And right now all of those positions are in the red, but they've also been buying it here and here and here and here. They're going to make money on every one of those positions. So we've spoke about what the US is doing to an extent. I mean, it's quite clear to see. All you have to hear is inflation going up to 4%, and you know it's going to be aggressive. You know that they don't want to go into a recession or anything of the sorts. We look at China, who are doing something completely different. And we have to then ask the question, how is this going to affect the US market? How is it going to affect things in general going forwards? So what is China's cross-cyclical economic policy strategy, and how does it differ from counter-cyclical, okay? So a cross-cyclical approach means taking action sooner, in smaller steps, and with a longer time frame in mind, okay? It is a departure from counter-cyclical, which is when central banks and governments add stimulus to spur a slowing economy. We've been seeing this constantly, but if you really bring yourself back to, I believe it was just after the March crash and the Fed was pumping money. We have the Jerome Powell meme of him literally printing money. China's attempted to take a different approach here. But officials have not outlined what cross-cyclical policy actually entails. At least we know, when you up inflation, when you create more jobs, when you put more money into infrastructure, when you print more money, when you pump it into the market. We know what the outcome is. We know what that means. We don't know what this means yet. Again, uncertainty, my friends. There are so many unanswered questions out there. Now, look, I don't think there's anything wrong with dollar cost averaging. The most famous quote potentially in all of the finance world, it's about time in the market, not timing the market. I've used it myself on several occasions, and I think it's true. But I also think that as times change, you as an investor have to change, and you as an investor, have to be willing to adapt. You potentially have to be willing to, take a chance, whether that means you're going to end up making more money or lose out on some potential gains. At the end of the day, I think it comes down to the research that you do and what opinions that leads you to form. And this is, why I can't get as excited about a lot of stocks right now, because even if a company is doing really well, and even if they're undervalued, I still think that there's a lot of potential for them to go down in the short term. I don't even mean weeks or months. It could be a few months. One of my very favorite examples of this is Corsair, who over the last 6 months have gone down 32%. We're trading at a PE ratio of 16.44, who had very, very good earnings, who are growing so quickly in a market that's growing so quickly. And I still expect them to go down. This is why so many people have gone to crypto as well, my friends, because, crypto right now is pretty easy money. I'm surprised I didn't get involved. I should have. That was a mistake on my part. We live and we learn. Maybe I will get involved on the next pullback. But if this video does anything, hopefully it can kind of give you an idea of why I can't get as excited over stocks as I was able to a few months ago when everything was going up. When if a company had a good story, it would go up and you could make quick money. When if a company was undervalued, it would go up and you could make quick money. When earnings actually made sense and moved the company in the right or wrong direction. And don't get me wrong, I understand completely this is all a part of investing, but I also think that sometimes taking a little bit of a step back is part of investing. Now, does that mean I'm not going to keep up to date with all of my companies? No, of course I am. I want to know exactly what's going on with them because there's still some I want to buy at certain prices that I will be watching. Does that mean I'm not going to research new companies? No, whatsoever. I still am. I just don't get as excited as easily. But anyway, my friends, if you watch this video all the way till the end, you definitely are a true legend because it was probably a little bit more boring than our normal video, but I really, really do appreciate you from the bottom of my heart. I know a lot has happened as of late in the stock market with this channel, etc., but to the guys who are still here, especially if you've watched this video till the end, you are such a true legend. I don't know how to describe it. Your support genuinely just drives me on every single day. That's not a joke. I am deadly serious. So thank you so much. If you did enjoy, could you please help me out by hitting that like button, drop me that comment down below, and please, my friends, subscribe if you're new around here. Anyway, guys, I hope you all have a beautiful, blessed day. I'll see you in another video very soon. Peace.